Hi there. Welcome to another introductory but important review on financial reporting and analysis, which deals with financial reporting mechanics. This is reading 23 of the CFA curriculum. So we'll start by introducing the 5 elements of the financial statements, namely assets, liabilities, owner's equity, revenues, and expenses. We'll explore each of these items in more detail in coming reviews. However, we'll give a brief introduction here. Understand the processes behind double entry bookkeeping. Very importantly, understand what accrual accounting means. According to me, the most important section of today's review. Must pay great attention when this is being discussed. Forms the foundation of all accounting that we will study in subsequent reviews. Finally, we'll wind up by understanding quickly the relationship between income statement, balance sheet, and cash flows. Now, first of the 5 elements is categorized as assets. We'll read about assets, liabilities, and owner's equity in more depth in reading 26, that is understanding balance sheets. However, we'll do a brief review here. So assets are the firm's economic resources. So there are items that will bring us benefit in the future or bring us cash in the future. Some examples include cash and cash equivalents. So cash is in our bank's current account or saving account, and cash equivalents are liquid short-term securities. So they're normally debt securities that will mature in less than 90 days, and they are considered equivalent to cash as they can quickly be converted to cash if required by selling or disposing of in any other manner. So cash and equivalents can be deployed to purchase investments or in setting up plant and machinery, etc. It is the most liquid asset. Accounts receivables represents the company's debtors. So these are customers or other parties to whom the product has been delivered, but they are yet to pay us. Accounts receivable often have an allowance for bad debt as a contra account. So let's say that I have on my books a receivable of $100, and I feel that $10 out of this 100 are quite difficult to recover, so most likely it will not come back. As prudent accounting, it is wise to knock that $10 off the income statement as a bad debt write-off and reduce this account receivable by $10, representing fairly to the shareholders that only $90 is receivable, $10 is unlikely to come back. So there'll be a contra account called allowance for bad debt. It's a contra account because it will be represented on the asset side, but it reduces the value of an asset. So it'll be minus 10, giving the net value of our asset as $90. Inventory consists of raw materials, semi-finished goods or work in progress, and finished goods that I have not been able to sell off yet, which is all sitting in my godowns. The inventory will be sold in the near future and will generate cash and other benefits that can be deployed for various uses. So it's also an asset. Financial assets include investments in equity or debt instruments issued by other companies or other institutions. These securities can be sold off or will generate dividend or interest income as an economic benefit in the future. So marketable securities are a very common example of financial assets. Prepaid expense is an expense that has already been made. So the cash has already gone out of our books, but we haven't yet received the service or the product that we paid this expense for. So I paid $100 to get my factory serviced this year. However, the repairs on the factory did not happen. So I haven't yet shown it as an expense because the expense hasn't yet taken place or the service hasn't yet happened, but the $100 of cash has been given as advance. So this will be a prepaid expense of $100 on the books. Cash goes down and another asset goes up. As the factory gets serviced, the $100 of expense will come on my income statement and this asset will get extinguished. We'll study in more detail in coming reviews. Property, plant, and equipment represents a long-term asset or a fixed asset. So it is the investment in property, plant, and equipment that will generate future operations or future cash flows. We will get our product, we will sell it, and we will earn profits in the near future because of our investments in PP&E. So the property, plant, and equipment is constructed over a shorter term, over 2 or 3 years normally. However, the expense is taken on the income statement over a longer period in time through a concept called depreciation that we will study. So at any point in time, the value of the property, plant and equipment is carried at as the historical cost minus the accumulated depreciation. So just like allowance for bad debt reduced the value of my accounts receivable, accumulated depreciation reduces the value of my property, plant and equipment. So it is also a contra asset account. Contra implying that it reduces the value of another asset. Investment in affiliates represent strategic stakes or long-term investments in another company's debt or equity. So if I own 30-40% of the equity of another company, then it's not a marketable security because I won't be able to sell it out in one shot or over a short period in time. However, this investment is expected to bring me benefit over the longer period in time. Similarly, I could have given $100 million loan to another company, which may be a fairly significant amount. So investment in another company's debt or equity of a more significant nature is referred to as investment in affiliates. They are often accounted using the equity method that we will study in more detail at level 2. So you don't have to worry about that at CFA level 1. Intangible assets are also long-term assets that do not have a physical form. We'll study about them in more detail in understanding balance sheets, but just for example, patents, trademarks, goodwill are some examples. Just like property, plant and equipment gets depreciated, intangible assets except goodwill get amortized. So their value is reduced by a contra account called accumulated amortization, very similar to accumulated depreciation. Another asset account that you may sometimes see is called deferred tax assets. We'll study it in more detail in the review of reading number 31 of the CFA curriculum. The liabilities are the economic opposites of assets. They represent claims on the company's resources, or they are items that will result in an economic outflow or a cash outflow. A very common example is accounts payable or trade payables. These are amounts that I owe to my suppliers. So I have used the raw materials, or rather I've purchased the materials but haven't yet paid my suppliers, would be represented on the balance sheet as a payable. Financial liabilities like short-term debt or short-term notes payable are very common. Unearned revenue, also known as customer advance, can be a liability. So my customer has paid me $100, but I'm yet to deliver him the product. So cash on my books has gone up by $100. But before I use up this cash, please note that I have to first deliver the product to my customer, or there is a liability called unearned revenue or customer advance to the tune of $100. As I deliver the product, the unearned revenue will become an earned revenue or will come in my books as a revenue, and this liability will get extinguished. So these are items that will show up on the future income statements as revenues once I deliver the product. Income taxes payable are taxes that have been accrued in the past but haven't yet been paid to the government. Just like we took short-term debt, we can also take long-term debt, commonly referred to as bonds payable. So this will be retired over a longer period in time. And finally, just like we had deferred tax assets, we can have deferred tax liabilities. We'll study in more detail in reading 31. The third and final broad category of the balance sheet is referred to as owner's equity or book value. So the owner's equity represents the shareholder's residual claim on the firm's resources. So this is the liability of the company towards its owners. Please remember that shareholders of a company are the owners of the business or the owners of the company. Owner's equity can be calculated as the net assets, that is, after paying off all external liabilities, whatever remains belongs to the owners. Now let's study with an example how owner's equity gets created and impacted. So let's assume that I want to start a business that will require an investment upfront of $100 in plant and machinery. So plant and machinery goes up by $100. To fund this asset, the bank is willing to give me a loan of up to $50. So I take debt financing of $100. And to begin with, my initial equity shareholders put in an investment of $50. So let's say that I have 10 shareholders, each of which is issued one share with a par value of $5. $5 is called the face value or par value of a share, and 10 shares are issued to each of the 10 shareholders, and the share capital or initial equity of $50 is raised. This amount is called the paid-in capital. Remember, the paid-in capital is always equal to the face value into the number of shares. To begin with, there are 10 shares and the face value of each share is $5. Now in the first year of operations, let's assume that my company did sales of $100. All expenses including interest on this debt, taxes, employees, raw materials came out to a figure of $50, and hence my company generated a net profit of $50. The business is still in its first year of operations, and this was more like a pilot project that I started off with to check if the product is acceptable in the market. And the first year of operations suggests that the business has potential and should be scaled up further. So please remember that the agreement with the owners or with the shareholders is that all residual profits belong to the shareholder. All profits after paying off taxes, interest, SG&A, etc. belong to the shareholders of the company. And companies often share this profit with the shareholders by way of dividends. Since my company, however, is new and we need investments to grow, for the first year we've decided to pay no dividends, such that the entire $50 is reinvested back into the business, or we say that the equity has increased by $50, and the name given to this increase is called retained earnings. So at the end of the first year, the retained earnings go up by $50. Let's say I take additional $50 of debt also, such that I can make a further $100 investment in plant and machinery. $50 of the additional money put in by my equity holders and $50 more from the debt from the bank. So a P&M of $200 at the end of year one is what I start off with. I realize, however, that this capital is also not sufficient for my expansion plans at the moment. So the pilot was successful. Now I want to expand from one city to 50 cities in the country. So as I want to scale up my business rapidly, I often need more investment. And the bank is not willing to give me debt because there is only so much risk that the bank is willing to take. So I have to fund my business by both raising more equity and more debt. Now the initial value of each share was $5 when the share was issued. That was called paid-in capital. However, investors now see more potential in my business since the first year of operations has been quite successful and the product is well accepted in the market. So to give me or to invest money in my business today, investors are willing to pay me $20 per share, or that is the fair price of my stock today. Let's say that I need another $60 of equity to satisfy my expansion requirements. So with another $60 of equity and $60 of debt, I would be able to expand another $120 in my assets, and which is sufficient at the moment. So to raise $60 in equity that I need, how many new shares will I have to issue? The fair price today is $20. So if the company issues 3 new shares at $20 each, then will we be able to meet our equity requirement? So let's assume that the company creates 3 new shares and issues them to 3 new shareholders. What will that transaction do? It'll bring in another $60 to the equity, and it'll also increase my cash, or let's assume I invest that cash in plant and machinery. So it'll increase my plant and machinery by another $60. But please understand carefully how this $60 now gets accounted into the equity side. So it's just a classification that will vary. All equity, be it the initial paid-in capital, be it the retained earnings, or be it the equity from an external issuance, have same economic significance and require the same return to be given to the investors. So the paid-in capital or the share capital, as we studied earlier, is equal to the face value into the number of shares. Now the face value of each share was decided at the beginning and was $5. So we issued 3 new shares. That means the face value will go up corresponding to these 3 new shares. That is 3 into 5, $15. So the paid in capital will go from $50 to $65. That is another $15. However, I raised a total of $60 in equity. That is, there's another $45 that still has to be accounted for. That $45 is entered in a category called additional paid in capital. The additional paid in capital represents the amount received from issuing shares over and above the par value. So if I issue shares over and above their par value, then the additional amount is entered in this category. So the additional paid in capital will be 60 minus 15, that is $45, giving me a total equity of 65 plus 50 plus 45, that is $160. And let's assume that on the $60 in new equity, I'm allowed to raise $60 more of debt. As with more equity, the bank is willing to fund me with the debt so that I can expand another $60 on my asset. So let's see what the balance sheet would look like at the end of the first year after I've done the equity issuance. My assets, that is the total plant and machinery, would become a figure of $320. My debt would have increased to $160 as I expand more on my assets. And my total equity has become $160 as described under the 3/8. So the paid in capital would be $65. The retained earnings is $50. That comes from the amount reinvested from the net profits, and an additional paid in capital of $45. So please note that equity can come in through various sources: retained earnings, issuing new shares. However, all equity represents a liability to my owners and it needs to be given a return on equity or a fair return that the investors desire for the risk that they're taking, as we'll study in capital budgeting and corporate finance. So that's just the accounting aspect and the classification of how owner's equity gets generated and accounted for. So owner's equity consists of capital or share capital, also known as paid in capital, as we just studied. That is simply the par value of the common stock. That is the number of shares multiplied by the face value per share. This is also called share capital. Additional paid in capital is the sales in excess of par value, or that is the stock sales. So that's the premium that we get for issuing new stocks, also called as share premium reserve sometimes. Please note that the capital plus the additional paid in capital is also called as contributed capital or common stock. Companies sometimes can repurchase and extinguish the shares. So share repurchases that the company has made are represented in a contra equity account called treasury stock. The treasury stock is the amount of equity that has been repurchased, and treasury stock has no voting rights and gets no dividends. Retained earnings is the cumulative net income that has not yet been distributed as dividends, as we just saw. One last equity account that we'll study is called as accumulated other comprehensive income. This account contains the total changes resulting from 4 transactions, namely foreign currency translation, minimum pension liability, unrealized gains and losses on available for sale securities, and unrealized gains and losses on cash flow hedges. So as we'll study that these 4 gains and losses are not taken through the income statement but are adjusted directly in the equity in the other comprehensive income. The accumulated other comprehensive income is an equity statement item that contains the cumulative changes from all these accounts. The first 3 elements that we studied were related to the balance sheet. The next 2 elements that we will study are from the income statement, namely revenues and expenses. So revenues represent inflow of economic resources, broadly including sales, that are the revenues from the firm's core operations or day-to-day activities, These are inflows from the stated objective of the firm. When you establish a company, you need to register your company with a stated purpose. That is, I'm a pen manufacturer or I'm an automobile manufacturer, etc. So whatever revenues are coming from those core operations will form a part of my sales. Gains are also profits, or there are increases in the value of the asset and hence the increases in equity that result from incidental operations. So let's say I had some land historically that I sold in this period. So the gain that I'm achieving on that land sale will be categorized as a gain. So it is also a part of the revenue account. However, it's not from the core operations and is not expected to repeat every period and hence is represented separately as gains from transactions that are incidental to the firm's day-to-day activities. Investment income is another very common revenue account. This comes from the interest earned or the dividend income received from the various investments that we have made from time to time. So this income can also be considered to be repeatable as long as the cash does not get invested elsewhere or the investments don't get liquidated. So interest and dividend will keep coming on our investments. The last account that we will pay focus on in this review is called expenses. So these are the opposite of revenues or represent outflows of economic resources and include cost of goods sold, that is the raw material expenses for creating my product. Selling, general and administrative expenses are normally fixed in nature. These include advertising expenses, salaries of the management, rent, electricity bill, etc. Depreciation and amortization, as we studied earlier, reflects the using up of tangible and intangible assets. Depreciation for tangible and amortization for intangible. We'll study this in more detail in many future reviews. Tax expense is owed to the government. Interest expense has to be paid on my debt. So the agreement with debt holders is that they will get a fixed interest regardless of the performance of the company. Just like we had gains in the revenue, losses are from incidental activities in the expense account. That is, in the same land sale described earlier, if the land was sold at below its cost price, then there won't be any gain. However, there would be a loss that would be reported on the income statement. Again, that loss is not expected to repeat again and again. It is from an incidental activity that is peripheral to the firm's day-to-day activities or not core to the firm's business. Please commit to memory the basic accounting equation that says that assets on the balance sheet must equal the liabilities plus the owner's equity. So all assets will either be used to pay off the liabilities or they belong to the owners. In other words, the owner's equity is equal to the assets minus liabilities. So very important, guys, this equation is always true on all balance sheets. If it is not, that means that you are making some mistake. So be careful about that. The owner's equity can further be split up as the contributed capital, that is the parent capital plus the additional parent capital, plus the ending retained earnings. The ending retained earnings can be split as the beginning retained earnings plus the retained earnings of this year, that is the profit minus dividend, or the revenues minus expenses minus dividends. So never mind the other two formats, they're just an expansion of the basic equation, that is assets equal liabilities plus owner's equity. Now the concept of double entry bookkeeping says that every transaction must be recorded in at least two accounts, that is assets, liabilities, owners, equity, revenues, or expenses. It is alright if it affects the same account twice in different heads, but all transactions must affect at least two accounts. Let's understand with the help of an example. So if we purchased property, plant, and equipment worth $20,000 in cash, which two accounts will be affected? Cash, which is an asset account, will reduce by 20,000, and another asset account, that is property, plant, and equipment, will go up by 20,000. So in the first example, both asset accounts are getting affected. If we borrow $15,000 to purchase equipment, so again, on an asset account, that is property, plant, and equipment, there will be an additional $15,000. That is the equipment that we have purchased. However, correspondingly, a liability, that is debt, will also increase by $15,000. Please note that the double entry bookkeeping ensures that the basic accounting equation is always maintained. So if an asset account goes up, another asset account comes down as well. If an asset account goes up, we also see correspondingly a liability account going up. Buy office supplies for $3,000 in cash. So cash account, that is an asset account, will go down by $3,000, but another account, that is expenses, will go up by $3,000. These expenses going up will reduce my net profit and eventually reduce my equity, that is the retained earnings, will be lower to the tune of $3,000. Buy inventory for $8,000 cash and sell it for $12,000 in cash. So when you purchase the inventory, the cash, that is an asset account, will go down by $8,000, and correspondingly another asset account, that is the inventory, will go up by $8,000. Subsequently, when you sell the inventory for $12,000 in cash, cash will go up by $12,000. This inventory will come down by $8,000 since it's already been sold. Revenues will go up by $12,000. So that is the impact of the second transaction independently. Revenues will go up by $12,000 and cash will go up by $12,000. Similarly, expenses will go up by $8,000 as this revenue has a corresponding expense of $8,000, that is the cost of purchasing the inventory, and the inventory will go down by $8,000. That's the concept of double entry bookkeeping. Every transaction must at least affect two accounts. It can affect more than two accounts also, but it should at least be recorded in two accounts. It can be the same broader account, that is an asset or a liability, with two different heads under it that are getting affected. In cash accounting, revenue is recognized when the cash is received and an expense is recognized when the cash goes out. So revenues and expenses on the income statement are dependent entirely on the cash inflows and outflows. Let's see with an example the problems with this method and why this method is normally not followed anywhere in the world. So let's assume that I buy inventories for $8,000 cash in year 1 and sell it for $12,000 cash in year 2. How will my income statement look in year 1? My sales will be 0 since I have no cash receipts in year 1. We're following cash accounting. And my expenses will be $8,000 since I have paid out $8,000 for purchasing the inventory. Or my net profit in year 1 will be minus $8,000. Let's see what will happen in year 2. In year 2, I have sold the inventory for $12,000 in cash. So I'll have a sales of $12,000. And has any cash gone out? This inventory did actually cost $8,000, but the cash has already been paid in year 1 and it has been expensed then. So no incremental cash outflow in year 2, or the profit will be $12,000 in year 2. The total profit over the 2 years is $4,000. However, the individual year's profits are highly volatile. There is a minus 8,000 one year and there is a plus 12,000 in the second year. So we see that if we follow this method, then earnings will be very volatile and projecting earnings is going to be very difficult. As if I'm deciding to store some inventory or buy some extra goods, then it will all result in a big loss. And if in a particular year, if I'm liquidating my inventory, that is, I'm not procuring more, then it will be a great profit, which is not intuitively the correct way of looking at things. This $12,000 of revenues were not free. There was actually an associated cost. And in year one, there wasn't really a loss of $8,000. It was just that we had purchased the inventory and we were unable to sell it. So on the whole, there was a $4,000 of profit that should have been recorded in year two when we've sold the product. And this is the concept followed in the more prevalent method of accounting globally, and that is called accrual accounting. So this is the method that is actually followed and will be used in all subsequent reviews of financial reporting and analysis. In my opinion, the single most important concept in creating accounts that you need to remember and understand. So accrual accounting says that revenue must be recognized when the product is delivered. If you've delivered your product, you have to recognize the revenue regardless of whether you've received the cash or not. So revenue must be recognized when the product is delivered or the service is rendered. And correspondingly, we need to apply the matching principle, which says that expenses must match revenues, regardless of when the cash outflow for the expense is happening. It can happen sooner or later. So once again, revenue must be recognized when the product is delivered and expenses must match revenues. Let's understand the concept with an example. So going back to the same question, if we buy inventories for $8,000 in cash in year one and sell them for $12,000 in cash in year two, how would the income statements for the 2 years look like? So for year one, what will my sales be? Have I delivered any product or rendered any service? No. I've just purchased inventories for $8,000 cash in year one. So my sales will be 0. And according to the matching principle, corresponding to this sales, what are the expenses? There are no fixed costs that I'm given any information about. So for 0 sales, there is no expense. However, I did purchase an inventory for $8,000 in this year. So how will that transaction get recorded? Please note that that's how our balance sheet items get created, or that is the link between the income statement, the cash flow statement, and the balance sheet. So balance sheet items come because of a mismatch between the income statement recognition and the cash flows. So there is no expense that has been recognized. However, a cash outflow of $8,000 has come in year one. Hence, a balance sheet account inventory will be created that will go up by $8,000. That is, as assets sitting in my books will be realized when it is sold, and the cash will go down by $8,000. Let's see what will happen in year two. In year two, I sold my inventory for $12,000 in cash. So my sales in year two would be $12,000. But did this sale come free of cost, or was there an expense for selling this product or for procuring this product? Yes, this expense or this product was actually costing me $8,000. So expenses must match revenues regardless of when the cash outflow for the expenses happening. So the expense of $8,000 would mean a net profit now of $4,000. Again, the cash inflow is coming, however, this outflow has already been made in year one. As there is a mismatch between the income statement recognition and the cash flow, again the balance sheet items get affected. So as the sales come in, the cash will go up by $12,000, but this expense was already made. I already had a cash outflow of $8,000 for procuring the inventory. So I will not reduce the cash by another $8,000 because the cash has already been spent. However, I don't have any remaining inventory in my go down any more. So my inventory from the previous year will go down by $8,000. So on the whole, over a 2-year period, my cash will go up by $4,000 as the profit I have generated in the overall transaction. So we will keep referring to the principle of accrual accounting in practically every review henceforth, and we will understand it better as we do more and more examples of these types. But I hope you've understood the broad concept behind accrual accounting and how income statement items and balance sheet items get created. Following on with the concept, let's see how various balance sheet items get created. For example, unearned revenue comes into existence when the customer has already paid me the advance, or he's already paid for the product. However, the product has not yet been delivered. So on the income statement, there is no revenue that is recognized because the product has not been delivered, but the customer has already paid me the money. So my cash goes up, and correspondingly a liability account goes up called customer advance or unearned revenue. As the product gets delivered or the service gets rendered, this customer advance will move into the revenue stream. Accrued revenue, similarly, is an asset account that gets created when the revenue has been recognized. So I have delivered the product, but the payment is still not due. So my agreement was that the customer will pay me 3 months after the product has been delivered, after checking the condition, and when he's satisfied, he will make the payment. So as I delivered the product, I recognize the revenue of $100. However, this revenue is still not contractually due, that is, it'll come to me after another 3 months. So at the moment, there will be no cash addition in the balance sheet since this revenue hasn't yet come. However, there will be an accrued revenue on the balance sheet that will increase by $100. It is an asset account. Prepaid expense, as we studied, is an asset account representing that the cash for an expense has already been paid, but that expense is still not been recognized because the product has either not been delivered to me or the service or the repair that I asked for hasn't yet been done. So the expense hasn't been recognized, but the cash has already gone out. Hence, there's an asset called prepaid expense that will go up to the extent of the cash outflow, representing that this service still needs to be done. And when that service is rendered, the prepaid expense will get extinguished and I will actually recognize the expense corresponding to what I had paid for. Accrued expense, similarly, is a liability that represents an expense that has already been recognized on the income statement, or wherein I have already received the product or enjoyed the service, but I'm yet to pay for the expense because the expense is not yet contractually due. So I received the consultation for a new project worth $100. However, my agreement with the consultant is that I'll pay him at the end of the year. So when I'm making the accounts semi-annually, there will be an expense of $100 to the extent that I have used up the consultant's services. However, I've still not paid, so cash has still not gone out. There will be a liability account, that is accrued expense of $100 that will go up, denoting that in the future $100 needs to be paid to the consultant. So balance sheet items get created because of accrual accounting, because there is a mismatch between the cash outflows and the expense recognitions, or there is a mismatch between the cash inflows and the revenue recognitions, so on and so forth. Very important, this concept, guys, and we will study more about it. This concludes most of the conceptual aspects of today's review. Let's take a look at a complete income statement for a particular period and identify the components. So sales of $54,600, cost of goods sold, wages, depreciation, the difference giving us the income from continuing operations, and it has an incidental gain that we discussed, not from the core operations, but from a peripheral activity like the sale of land to the tune of $8,000. Provision for taxes gives us the net income, a part of which is declared as dividends. We'll study more about the income statement in the coming review. However, please remember the sales figure from this statement that we will use in the coming section. So likewise, we are given the balance sheet as on the end of 2011 and the end of 2012. Remember, income statement is for a period, balance sheet is as on date. It is a cumulative position till the end of 2011 and till the end of 2012. Recall from the previous slide that the sales of the company was $54,600. So the asset side of the balance sheet has various components: cash, accounts receivable, inventory, fixed assets like land, plant and equipment, so on and so forth. Likewise, we'll see the liability side of the balance sheet. But if you notice one specific component, that is the accounts receivable, it has gone up from $12,000 to $14,500. What this implies is that of my entire recognized sales, not everything has come to me in the form of cash. $2,500 of the incremental sales has not been received as cash. That is why my accounts receivable has gone up. If I see what the cash received has been, it'll be 54,600 minus 2,500, that is the increase in receivables, that is to the tune of $52,100. We'll just see why this has relevance. But before that, let's take a look at the liabilities side of the balance sheet. So we have current liabilities, long-term liabilities, equity, common stock, retained earnings, components that we just discussed. We will see each of them in detail when we go on to the specific reviews. However, understand that given the income statement and the balance sheet, we can derive the cash flow statement as depicted. Or given the cash flow statement and the income statement, I can derive the balance sheet as well. So we saw that cash collections were 52,100. We derived it ourselves as well because the sales was 54,600 and accounts receivable had gone up by 2,500, implying a cash received from customers to the tune of 52,100. Why this is important is that we could similarly determine each remaining component of the cash flow statement, as we will study in more detail when we do the review on cash flows and the cash flow statement. But understand that the three statements are interrelated, that is, given two, I can derive the third. Statement of owner's equity depicts how the equity account has changed over the year. So if you'll see here that the contributed capital went up by 25,000 because the company issued new stock. Retained earnings went up to the extent of the net income minus the dividends paid. And the total equity, which is the sum of all, went up from 122,500 to 160,500 as a result of the two operations. So please pause the video in a while and indicate whether each of the accounts shown, so on and so forth, should be classified as an asset, a liability, owner's equity, revenue, or expense. So please pause the video here and attempt the question. Just denote the numbers and write whether it is A, L, O, R, or X. So we have the solutions depicted in the coming slides, but let's understand a few of the accounts. So please remember that accumulated depreciation is a contra asset account. That is, it reduces the value of my asset to the extent that I have depreciated it. So it is a negative asset. It reduces the value of my asset. Exactly similar is the explanation for allowance for bad debts. It is also a contra asset account. It reduces the value of my asset, that is accounts receivable. Current portion of long-term debt will be a liability. Deferred tax items can be both assets or liabilities. We'll study in the review on deferred taxes. Depreciation independently is an expense that comes in the income statement. Similarly, attempt the other page as well. pause the video here and solve the question on your own. Loss on sale of assets will be an expense. It will be an incidental expense. Other comprehensive income is an owner's equity account. Unearned revenue is a liability. Once you've attempted, here's the solutions for each of the items. Please make sure to refresh the accounts that you got wrong and understand why you got it wrong by watching the video once again. All the accounts have been discussed at some point or the other. Lastly, let's take a look at how information is recorded in an accounting statement. So all day-to-day entries are recorded in a journal, which shows which accounts are changed and by how much. So if a sale has happened, then the cash goes up, revenue goes up. So all these entries or all these transactions, expenses, assets, liabilities are recorded on a day-by-day basis as they are happening. A listing of all these journal entries in the order of their dates is called a general journal. A general ledger is the next step that will sort the general journal by account heads. So all revenue entries will be clubbed together, all asset entries will be clubbed together, all expense entries will be clubbed together in a general ledger. At the end of the accounting period, that is when I'm creating an accounts, I will sum up each of these accounts and prepare an initial trial balance. So it is the sum of all revenue accounts, all asset accounts, all expense accounts, which depicts the initial trial balance. If any adjustments need to be done or any adjusting entries are needed, then I do those and then prepare an adjusted trial balance. The account balances from each of these heads from the adjusted trial balance are finally presented in the financial statements. That's what the accounting team does or the accounting department does within a company. So that's about financial reporting mechanics. We'll start off by starting the first statement, that is the income statement, in the next review. So stay tuned and see.